Welcome to The Critique. Today we're looking at an outline for a video. It's called RZLV Stock Report, the bull case for $10 in 2026.
Right. So it's about RZLV AI, their platform, and this pretty significant Microsoft partnership that's backing it.
Exactly. And the goal here is a high-conviction case for some pretty sophisticated investors. So let's just jump right in. We've got 3 areas where I think we can really sharpen this up.
Yeah, I mean, the material does a good job of setting up the high-risk, high-reward nature of it all. That $10 price target is, front and center.
It is.
But for this kind of audience, the math behind that target really needs to feel earned, not just aspirational.
Yes. Earned is the right word. And that really brings us to the first big point. It's all about this massive, almost vertical growth that's required.
The bull case. The report absolutely must establish the how behind that massive 2026 revenue forecast. I mean, your first reason for the bull case, it hinges entirely on the company hitting a staggering $500 million annual recurring revenue, the ARR.
And they have to hit that by 2026, which, when you look at it, is just a colossal leap from their recent H1 revenue. What was it?
Just 6.3 million.
6.3? So the scale of that jump is, it's pretty dizzying.
It is. I mean, we're talking about an implied 80x growth factor in just a couple of years.
80 times.
Yeah. And for an AI stock, even a high growth one, investors need to see a concrete path. If the mechanism is just asserted rather than really supported, it just leaves this huge logical gap.
So the forecast feels ungrounded. For an audience that's used to mapping out adoption cycles, that's a red flag.
Exactly. So my suggestion is that the material needs a section that really contextualizes the scale of enterprise adoption that's required to drive the growth. We can't just, cite management targets. We need to visualize the pipeline for them.
I see that. But I wonder, though, how much of that specific deal-level modeling can really be done without, inside information? Are we asking for too much detail here?
That's a fair question. Look, we're not asking you to invent data. Not at all. It's about creating a model that's just consistent with what management must be assuming to hit that number.
Okay, so it's about reverse engineering their logic.
Precisely. So for some concrete examples, first, just call out that 80 times growth factor directly. Acknowledge it. Then you can clarify what that might represent. Is it, say, 5 to 10 massive enterprise deals, each averaging, $50 million in ARR?
Right.
Or is it a wider deployment? Hundreds of smaller retail clients using the platform.
So by providing those figures, even if they are hypothetical, it grounds the forecast in business reality. It's not just a number plucked from the air.
It becomes a bridge. The story shifts from they will hit $500 million to something like, to hit $500 million, they need to sign X number of Fortune 500 retailers, which you then argue is plausible because of the Microsoft deal.
Which is a much stronger argument. It preempts all those questions about sales cycles and competition.
Exactly. That bridge is structurally crucial for investor confidence.
That's a powerful way to frame it. Okay, so let's move on. Our second observation is more about the narrative architecture, the flow.
Yes, the structural flow of the bull case can be significantly improved by reordering the 3 core reasons. You need to prioritize validation over projection.
And right now, it's the other way around.
It is. As it stands, the report presents the most speculative element, that aggressive $500 million forecast, as reason number 1.
So you're asking the reader to accept this massive future outcome before you've even shown them the catalyst that makes it possible.
Which is the Microsoft golden ticket in reason number 2.
Exactly.
You're forcing them to suspend disbelief. You're asking them to believe in the destination before you've even shown them the engine.
Okay, but let me just push back on that for a second. Doesn't leading with Microsoft's, doesn't that make it feel like a single point of failure argument? If the partnership is reason 1 and it fails, the whole thesis just collapses.
That's a good counterpoint. But look, the current structure already has that risk, because the $500 million target is entirely dependent on Microsoft making it happen anyway.
True.
The difference is all about narrative conviction. By putting the Microsoft partnership first, that aggressive revenue forecast becomes a credible consequence of that foundation. You establish the why before you predict the what.
And that foundation is pretty solid. We're talking a 5-year agreement, Azure Marketplace integration, and this is the big one, that $130 million go-to-market commitment.
That is the core asset. So the suggestion here is really actionable. Switch reason number 2, the Microsoft golden ticket, to become the new reason number 1.
Put the most concrete, de-risking element right at the front.
Yes. Then you can rename the current reason 1, the forecast, to be the new reason 2, and you frame it as the growth outcome driven by Microsoft. See the difference?
Yeah, it immediately feels more validated. The partnership proves the market acceptance.
In reason 3, the Wall Street consensus can just stay where it is. It becomes the final confirmation of the growth you've now logically established. It's just a much more persuasive journey for the reader.
So the goal isn't to change the facts, just optimize how they're presented, moving from, interesting to truly persuasive.
That's it.
Okay, so our final critique. This one is about risk. I mean, this is a bull case, but high conviction isn't built by ignoring risk. It's built by neutralizing it.
That's the key. You have to acknowledge the wolves at the door, but immediately show the armor.
Right.
The current risks section, it highlights 2 big ones. Cash burn, they only have, $9.9 million in cash, which suggests dilution is coming, and execution risk.
The danger of just failing to hit those massive targets.
And the weakness right now is that the outline just kind of lists these like cautionary notes at the end. They don't feel integrated.
Exactly.
For a high conviction piece, these risks need to be proactively addressed and, neutralized within the bullish argument itself.
Especially cash burn. For a high-growth AI company, that's probably the biggest anxiety for analysts.
Absolutely. So instead of listing risks separately, the idea is to strategically reframe how the Microsoft partnership directly mitigates these risks. You use the details of that $130 million GTM support as a direct counterargument.
Okay, so let's break that down. Cash burn first. How can the GTM funding be used to neutralize that dilution risk?
Well, when you discuss the cash burn, you have to frame that $130 million GTM support as what it is, essentially non-dilutive capital.
Ah, okay.
That's the key phrase for this audience. You frame it as a kind of cash bridge. It directly substitutes for all the sales and marketing expansion that Resolve would otherwise have to fund with cash or, by issuing more stock.
It's a powerful point. Microsoft is essentially paying the sales salaries until Resolve can afford it themselves. That reduces the immediate pressure to raise capital before they hit that 2026 profitability target.
Precisely. The conversation shifts from they are burning cash to their essential sales infrastructure is being subsidized by a world-class partner. So what about the other one? Execution risk, the fear of missing that target.
Right. The main execution hurdle for a company like this is always hiring and training a massive enterprise sales force fast enough.
Of course. So when you talk about execution risk, you emphasize that having Microsoft's own sales team pushing the Brain Suite through the Azure Marketplace, well, it dramatically lowers RZLV's direct sales burden.
They don't have to hire hundreds of reps overnight.
They don't. They get to piggyback on one of the largest, most trusted sales channels in the world.
Which makes getting those big enterprise contracts, the ones we talked about in the first critique, suddenly seem much more attainable.
That $10 target becomes achievable because the execution risk is being shared and largely handled by Microsoft. It turns a risk into another proof point for the partnership's value.
So by building in these proactive counterarguments, the whole thing just becomes a much more coherent, airtight investment thesis. You're using your strongest asset to neutralize your biggest vulnerabilities.
Exactly. We want the video to not just state that the stock could hit $10, but to logically compel the audience to believe why it will, even when you factor in all the risks.
This has been a really great breakdown. So just to summarize for our listener, we've identified 3 key opportunities here to really strengthen this report.
First, you have to address that completeness and focus. Provide the sales mechanics behind the $500 million target. Show us the math, even if it's hypothetical, to prove the trajectory is earned.
Second, focus on the structure and flow. Reorder the bull case. Lead with the concrete foundation, the Microsoft's golden ticket, before you get to the projection it enables. Establish the why before the what.
And finally, you can maximize the conviction by integrating risk mitigation right into the thesis. Frame that $130 million GTM commitment as the non-dilutive capital and the Salesforce multiplier that neutralizes cash burn and execution risk.
I think these revisions will really transform